Hello, I am Devashish Chakravarty. Let us today look at measuring company performance through ratios of fund flows. How do we evaluate company performance? The company performance is seen from its balance sheet, from its income statement, and from its cash flow statement. From these three statements, investors and other people who study the company have developed a set of ratios. What are ratios? Ratios are when two numbers from the balance sheet, the profit and loss, or the cash flow statement are compared to give an idea of how the company is being run, its output, whether it's a sustainable candidate for the long term, whether it's a wise decision to invest for the long term, and a comparison between the company's performance versus other companies in the same domain. There are various ratios that are developed. Then what are fund flow ratios? Fund flow ratios are those ratios that relate to the flow of cash, whether at the operating level or whether at the raising of funds level. So let us look at how can we look at company performance with relation to fund flow ratios. One of the first ratios that we can consider is the operating cash inflow. What part of the total cash that is flowing into the firm comes from operations? What are the operations of a firm? It might be the sale of goods or services. Now this sale will yield a certain amount of cash which would be known as the operating cash inflow. Compare that to the total cash inflow of the firm. Where will the rest of the cash inflow come from? It might come from various kinds of investment opportunities or activities, like for example the sale of an asset. Or it can come from various kind of financial activities, like for example investment of funds in financial instruments which give a return. The ratio of the operating cash inflow to the total cash inflow of the firm would give the operating cash inflow ratio. What does this give us an idea of? This gives us an idea of how much of the business of the firm comes from its core competency, and thus you can take a call on the sustainability of the firm. It also gives us an idea of that these are the regular cash inflows which are likely to repeat over the next few years. You can compare this number with other firms in the same domain and find out how well is this firm doing. Similarly comes the operating cash outflow ratio. What is the operating cash outflow? That portion of the money that is flowing out of the firm, that the firm is paying out, that portion of the money which is going towards operations. In the first case, operating cash inflow, higher the number the better. In the second case, lower the number better. If the operating cash outflow is low, it's an indication that the firm is probably highly profitable, because the rest of the cash outflow of the firm would go into either investment activities or financial activities. The firm might go out and buy an asset. This is not an indicator of the firm's profitability. However, if a high amount of money is going into operating expenses, it's an indication that the profitability of the firm might be low. Let us look at the third and final ratio with relation to funds, which can give us an idea of the performance of the firm. And this would be fund flow adequacy ratio. What is the fund flow adequacy ratio? This is observed generally over a long period of time, say 5 years. It is a comparison of the total funds flowing into the firm or raised by the firm compared to the total fund outflow from the firm. When the outflow of the firm, funds outflow of the firm consists of purchase of assets, any increase in inventory, that is increase in working capital requirements, and dividend payout. What will be the fund inflow of the firm? The fund inflow of the firm would primarily come from the cash reserves, the additional profits that are generated year on year. Why do we look at it over a 5-year time frame? So that all the cyclical factors are eliminated. If over the last 5 years, the total additional funds generated from the firm's activities is sufficient enough to take care of whatever increase in inventory or working capital is required, whatever dividends payouts are supposed to be made to shareholders or expected by shareholders, and also has enough cash flow to buy whatever additional assets it needs to invest in, then the firm is on a safe footing. Similarly, you can compare the firm to its competitors on the funds flow adequacy ratio. If the ratio is less than 1, it would mean that additional funds are required to be raised, either to meet its inventory requirements or to meet the expectations of the shareholders, which means that dividend payout would happen in the absence of adequate funds, or to invest in growth opportunities. So we come to the end of study of company's performance based upon fund flow ratios.